So here's a simple mistake that a lot of new investors make. Let's say you're looking at two different stock prices, and we'll use Snapchat and Sunoco as an example. Snapchat's trading at $13.15 a share. Sunoco is trading at $44.52 a share. And you're like, wow, I can't believe that Snapchat is cheaper than Sunoco right now. But actually, it's not. And it's because of a concept called market cap or market capitalization. And if you already know this and you think nobody would ever make that mistake, you're wrong, because I used to make that mistake. I remember telling somebody one time that I wish I'd bought Google at $1. It was never $1. They IPO'd at $85 in 2004. But I didn't know anything. It was 15 years ago. My point is, we all start somewhere. Don't worry if you didn't know. So market cap is a total dollar market value of a company's outstanding shares of stock. In a nutshell, it's how much a company's worth on the stock market. And it's calculated by simply multiplying the current share price to the total number of shares outstanding to get the total market capitalization. So if we go back to the Snapchat and Sunoco example, even though $13.50 a share is obviously less than $44.52, Snapchat has 1.61 billion shares outstanding, while Sunoco only has 84 million shares. So that gives Snapchat a market cap of over $21 billion, while Sunoco only has a market cap of about $3.7 billion. And that means for the companies to be worth the same amount, Sunoco would have to have a share price of $252.68. So just looking at the price of a stock isn't going to tell you whether it's cheaper or more expensive than another. Now, it might be in terms of share price, but the percentage of the business that you get back in return is going to depend on the total number of shares they have outstanding. So you might be like, okay, I get it, but why does this matter? Understanding relative value helps us make better decisions. And so number one, when people say Dogecoin's going to $1, that would mean that it would be worth $140 billion total. And that's as valuable as companies like Intel, Verizon, and Disney. Now, I'm not trying to say whether Doge can or can't do that. I'm just trying to give you an idea of what that means in terms of size and how big it would be if that happened. And two, the other thing market cap helps with is understanding the impact of the number of shares that a company has on your investment. If a company keeps issuing new shares every quarter, then even though the price of your shares might stay the same, the total percent of the business and future value is less than it was before. That sucks, and that's why we look at shares outstanding and stock-based compensation anytime we value a stock. Diluting shares is a silent killer to your investment, just like inflation is a silent killer to your dollars. So even though it sounds kind of weird, the price of a stock doesn't really tell you whether it's cheap or not. The market cap and the shares outstanding can tell you a bit more, and they can be found on just about any stock quote on the internet. So not only price, but the dividend yield of a stock doesn't really matter either. Now, if you guys want to find out why, click on this video right here where I walk through a step-by-step example. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.